Hi, this is Pro Exam. Welcome to this live Wednesday webinar where we're looking at the end of our series over the last month, last 4 weeks at the end of 2021. We've been looking at planning to save capital gains tax. And today's event, which was streaming on Zoom, YouTube and Facebook, we're looking at a combination of that. Because one of the best ways to avoid capital gains tax is to die. Now, I'm putting that into context. We've all had a difficult year and everyone's panicking going into the new year. But one immutable fact that we've got in our life is that we are going to die one day. If we're unlucky, it might be sooner. If we're very lucky, it might be later. But we've seen the world population double in the last 20, 30 years around the world. But that's mainly because 45% of the world's population is under the age of 25. And that's where the world's population growth has come from medical advances preventing child mortality. So now a family doesn't need to have 4 or 5 or 6 children to survive and grow. And you see in USA and Europe, family birth rates of 1 to 1.5%, which obviously is not going to replace the 2 adults who are the parents. So it's an interesting world we live in, but all those people are going to die. And we've got this imbalance in the world at the moment with the older people and a lot of younger people just coming on stream to support that. Capital gains tax is charged on the business that we build. So the elders, as they build business, as they own property and that property price goes up, that creates wealth, which is a liability to capital gains. Now, we've covered it in a number of webinars in this series, so you can go back and you can watch through those about how capital gains are taxed is taxed on property sales, on business sales, and on investments and personal possessions. That can change around the world depending upon the circumstances. So an expat living and working abroad can choose a jurisdiction which could give them a better tax regime than in another country. So in the UK, residential property capital gains tax has gone up a lot in the last 5 years and now stands at 28% for high rate taxpayers, whereas in other countries, there's no capital gains tax on business sales or property sales or a lower rate. So this is what we need to consider for expats who've got business across borders, who have got property in different locations around the world, who may have a tax residence in one country, be working in another. How can they best plan to organise their assets so in the long term, not only can they save capital gains tax, but can save inheritance tax for their family as well. Inheritance tax is charged on your domicile, not your tax residence. So your tax residence is where you're living this year and where you're paying tax on your money, on your income and your wealth. Where you're from is generally your country of birth. It's not that detailed, not that specific. It's actually related to your parents' birth as well, what their nationality is. So UK citizens giving birth to children in Singapore could still have UK citizenship and domicile for their children. It's just that on a temporary expat working contract abroad. Conversely, depending upon individual countries, it might be also possible to normalise and get residential and citizenship in the country of birth. So after 5 years, you can get permanent residency and then citizenship between 5, 10, 20 years later in the country in which the expat will be born, and that can alter domicile. If an expat wants to leave the UK and lose the domicile to the UK, then they need to be doing that over up to 20 years' time. So if a British citizen leaves to work abroad, age 25, and 20 years later, in their late 40s, they're still working abroad, and they've been essentially a tax resident in one other country for most of that time, which is not the UK, they could change their domicile. After that brief intermission, one of the films I watched over the holiday period in December 21 was Sound of Music, and it's so old, dates back to the 60s, that it actually had an intermission, and that intermission is still in the replay if you watch it today. So I had a brief intermission there where we had a technical hitch, had some earthquakes where I am this morning, which is been equally fun. So what we're saying is that for an expat to change their domicile and lose their home country's domicile, you need to be abroad under international law for 20 years. So inheritance tax is your domicile. It is based upon your domicile. It's where you're from. It's where your parents are from. It's where you're born, or it's where you naturalize your citizenship during your lifetime. Once you have acquired domicile at birth, to change that, or a domicile of origin or birth, to change that, you have to live as a tax resident in another country for at least 17 years. So it can take up to 20 years to change a domicile. Otherwise, you remain liable to your country of birth's domicile. So an expat could own properties in Spain, Portugal, Greece, Cyprus, Dubai, Singapore, or Florida. But if it's a British expat, the domicile can still apply to that estate, and it would apply to those global assets. So it applied to all the business and all the property all around the world. So that's the potential of inheritance tax. So capital gains tax is payable on any disposal of business or any disposal of property or investments during your lifetime, depending upon your current tax residence. But it could also be a charge on a fixed asset basis based upon where that real estate is: Spain, UK, Cyprus. Depending on where your tax resident is, you can have a capital gains tax assessment in the country where you're selling the overseas property, but still have a second assessment back in your home country. Sometimes your tax residents can avoid that capital gains tax assessment. But either way, your business across border, your overseas property assets, as well as your home country assets, are going to be liable to some sort of capital gains tax assessment right up until the day you die. And then there's inheritance tax to consider. And if you've not planned ahead over 20 years or more, then that's going to be your country of origin, your country of birth. So for a UK expat, the 40% inheritance tax on the worldwide assets, the overseas investments, the overseas business, the overseas properties in whichever jurisdiction is potentially liable to that inheritance tax on those worldwide assets. So it's clearly, it's a 40% tax that's looming. We said earlier that we know we're going to die at some point. So what can we plan to do to avoid inheritance tax and make sure that our wealth, when we no longer need it, passes to our family and not to the taxman? So that's the issues that we're looking at here. Now, starting from a UK perspective, there's often you get told you can give away $3,000 a year inheritance tax free, and you can, and it's nice to do that. But there are gifts that are exempt each year. So if the UK average property is worth around £240,000 at the moment, the inheritance tax allowance is $325,000. So you can give away, as a UK domicile citizen, $325,000 without inheritance tax. The 40% applies above that, which is quite comforting. So if all you own is your property in the UK and you've got precious little investments and a defined annuity pension, then you're not going to have that inheritance tax liability. But if you've got an overseas property and a UK property and a business and investments and a pension that is not being paid as an annuity, but it's a managed fund, then you have death taxes that are due. Now, the 325 allowance is for the husband and the wife. So if you're married or with a partner, that's 325 each. And if you've got a UK residential property, which is your main home, you potentially got another 350,000 between you, making that magical 1 million that a couple can hand over inheritance tax free. It doesn't necessarily apply like that, because if you're divorced, the husband and wife exemption won't apply. And if you haven't got a main residence in the UK, you don't get to use the 175,000 necessarily. So what can we do to plan to avoid those types of inheritance tax? Let's have a look at some of the alternative systems. And I just want to briefly look at two alternatives. Portugal apply a very, very simple system, which on the face of it sounds good. It's 10% flat rate inheritance tax, so it's 10% on everything. So there's no allowances to get confused with. There's no allowances where you can make arrangements for. Whatever your wealth is at death, you're going to pay 10%. So while a UK expat has got a personal allowance of 325,000 with zero inheritance tax, as a Portuguese domicile expat, you're going to pay 32,000 inheritance tax on that estate. And so the break-even point is actually, quite a bit higher. So you need to get to 425,000 in the UK, about 450,000 UK inheritance tax as an estate before you're paying any more than you would do as a Portuguese domiciled inheritance tax. And then you consider a third jurisdiction, Cyprus. The inheritance tax is zero. It's nil. There's nothing. We've already said in our previous webinars that there's no capital gains tax, and there's no on investments and on personal possessions. There's only a capital gains tax in Cyprus on Cyprus real estate, not overseas real estate, on Cyprus real estate. So so there's a capital gains tax on that. There's no inheritance tax at all from day one for a Cyprus domicile expat. And that's got a number of advantages, which we'll see later on. So with £1 million of UK domiciled worldwide assets, you've got no inheritance tax in the UK. You have 100,000 in Portugal, but you'd have 0 in Cyprus as well. But in the UK, you need to be married or in a civil partnership, and you need to have a main home in the UK to get access to that. If you're divorced, single, not got a UK main residence, then your allowance is 325,000 before you start paying tax. So on £1 million that you'd be paying about 200,000 inheritance tax, whereas in Cyprus, £1 million estate, you'd still be paying nil. In Cyprus, it's 0%, no matter how much. So if you've got a 10 million estate, it's 0 inheritance tax, whereas in the UK, you'd be paying 4 million. So there's quite potentially a lot of benefits. So how can you go around and go about planning to avoid inheritance tax? So as we've already alluded to in the UK, I'm going to focus on UK and Cyprus now. As we've alluded to in the UK, gifts between spouses are inheritance tax free. And so if you're gifting property to a spouse, that is tax free. So while an individual has got a 325,000 personal allowance, if they're married or with a partner on death, everything can pass to the spouse without inheritance tax applying, but it does apply on the second death. So the allowances carry over, and the inheritance tax is not applied until after second death. So £1 million estate is protected until after the widow dies. So another way in the UK that you can avoid inheritance tax is by giving it to blood relatives. Now, by this, it's a very simple and clear definition. It's blood relatives, it's issue. So if you're legally married, that's one thing, but the only other people that can benefit are your direct children and their children. So it's children, grandchildren, your bloodline. Obviously, with second and third marriages, that can add a level of complication. So where you've got a second marriage with children from 2 different marriages, the blood relative of the husband might be a different child to the blood relative of the wife. And so, again, the estate needs to be carefully planned and organised to make sure that there is no tax liabilities. And that means holding it in the right way in the first place. So it is possible to make inheritance tax savings, but that's by making an absolute gift. Now, an absolute gift means you have got to have no benefit from the asset afterwards. So somebody with a UK property cannot gift it to their children and then still live in that property or still treat it as their main home. It has to be gifted, absolutely. And obviously, with the previous capital gains tax liabilities we discussed, once the property is gifted, there's no inheritance tax, but then because it's the second home of the children, there's potential capital gains tax on the disposal of that property, 28% of that gain. So there are issues potentially down the line. So the gift has to be absolute. If an expat owns property in the UK, whether they're British or not, then they need to consider. So any if an expat is deemed to be non-domicile to the UK, there's still a potential liability to UK-based assets for inheritance tax. So even so, you may have had a residential property portfolio in the UK subject to 28% capital gains tax. That can still become 40% subject to the allowances. And we're talking about individuals here, not companies necessarily. So there's lots of different issues. And how we deal with it at ProAct is we consider ourselves to be a family office. We want to take care of family and their business and property across the borders and down the generations. And one of the ways to do that is to use a family trust. Now, a family trust means that the person putting the money into the trust, the person putting the property into the trust, the person putting the company shares into the trust is giving the benefit of that asset away, absolutely. Now, you could give it straight to your children, but then a subsequent divorce or illness or death would mean that benefit, that asset could be squandered. By putting it in a family trust, it protects the family's wealth, whether that's in overseas property, UK property, business shares, or investments. It protects that no matter what happens. If there's a divorce, if there's a death, if there's a long-term care, a dementia, Alzheimer's issue, if there's a divorce of children, for example. So if children have got a right to benefit from their parent under inheritance tax rules, while they're still married to another spouse, that spouse has got a right to that share and that settlement. So if you gift to your daughter and your daughter then gets divorced, the wealth that your daughter owns is shared with her divorcing husband. So the money can go outside the family in that instance as well. So there are these different issues. But if you gift to the family trust and you do it in such a way that it's construed that it's an absolute gift, the family can stay in control of that asset without expensive professional fees, but also without the 40% inheritance tax, without the capital gains tax. And also, if you're transferring UK property into a family trust, there's no stamp duty payable either. The trust can then own the property indefinitely. The trust potentially could sell the property as well, but without a capital gain, depending if it's somebody's main property. But most importantly, once the family's assets are in trust, they can pass down generation to generation to generation without probate. And if there's no probate administration when somebody dies, and remember, we're all going to die, the parents, the grandparents, the children, the grandchildren, they're all going to die. And each time somebody dies, there's an inheritance tax assessment. But once the property is gifted into trust and you make that arrangement for the family to stay in control, there's no further probate administration down the generations or across the borders. The trust might have its own tax residency and its own tax identity to deal with, just like a family company would have to do that. But it effectively takes the family's assets and protects them down the generations. So if you look at some notable examples in history, you've got the Wellcome Trust, which is one of the biggest drug companies in the world, but it is a trust. It's based upon a family trust. There's many other examples around Britain, if you look, and around the world. So when you see the likes of Elon Musk being criticised for not paying enough tax, because and Bill Gates, they own assets through foundations which protect them from, which are American versions of trusts. The Duke of Westminster used to be cited as the richest man in England. He never was. He doesn't own anything. The wealth of the Duke of Marlborough, the Westminster estate, is all in a trust established by the Duke of Wellington initially. in his prime after winning the Battle of Waterloo and being Prime Minister and saving the world to the UK. It's an early form of Brexit, wasn't it? Richard Branson, again, is using trust arrangements to own property, and it's gone to the extreme length of owning an island for his business. And again, it protects the family's assets across the borders and down the generations. So lots of different opportunities to do that, where you can save money. Probate administration in the UK takes around 9 months. In other jurisdictions, it can take longer. When you're going cross-border, you've then got to have certification and translations for the different jurisdictions. Different rules can apply. In Norway, for example, inheritance tax is charged on the beneficiary, not on the estate. So the beneficiary has to pay the tax, the inheritance tax anyway, rather than the estate, which means that a family could inherit a property but have to sell it to pay the tax, or have to get a mortgage to pay the tax. So there's lots of different catches for the taxman to have a last grab of your funds. For expats living and working abroad as well, if you've got a self-managed, self-administered pension scheme, and on death, the investment fund would suffer a tax, and it doesn't even go through the inheritance tax rules. So you could potentially pay a 45–50% tax on a pension fund to be left where there's no annuity for the benefit of the spouse or the children in the estate. So this is why we believe, despite the complexities that can arise with a trust, by planning ahead, moving your business and overseas property assets into a family trust and having the family control that through a board of trustees, which are essentially family members making those decisions, you can create the distance to avoid inheritance tax on your estate, and you can create a situation where the wealth can pass and be used down the generations by the family. So if the family owns a Cyprus villa, once it's gifted to the trust and the tax break is made, all the family members can use that property for their holidays every year. And the grandchildren and their children could do that as well as you now, if you wanted to maintain that portfolio. But it would be the same if you've got a company and you want your children to take over that company and run that company. You can avoid the probate and administration either by giving it away absolutely and losing the control, or using the family trust to set a legacy that passes on down the generations for you and your family, protecting you from inheritance tax and the cost of delay of probate when those things happen. Family trust also is a useful protection against dementia and Alzheimer's. It can be used solely for that purpose, but if in this context, we're talking about expats living and working abroad, planning long-term to change domicile, that they can take action now. They don't have to wait 20 years to be free of inheritance taxes. But by creating a family trust in a jurisdiction where there's no capital gains tax and there's no inheritance tax on gifts to the family, then you can avoid long-term tax on those capital assets. You may still be able to enjoy them as a family, which is okay. If you draw income, like if you draw dividends from a company, you might pay dividend tax. So there might be a tax at some point if you're drawing income, but to actually just own the assets you don't need them to be in your name. They can be protected across the borders, down generations, for when people die, not if they will die and if they won't die. So those are the considerations we consider in planning ahead. By taking the action now, you avoid the cost and delay of probate in one jurisdiction, or if you're owning overseas property or overseas companies, it avoids those as well. It's good planning for the family. It's good administration of your family's wealth, and it protects your children and their children from the events that go on, whether there's accidents, divorces, dementia, ill health, revolutions. Protect your family using a family trust is a way that expats can do that as soon as they start living and working abroad. For more information, contact us at probatepartnership.com, and we can organise a free review to discuss your circumstances. We offer a free review to all our clients. But if you're in the process of relocating abroad, we also offer retained client service, and you can join us at an early stage from just £30 a month and get access to our consultants who could advise you on investments, legal matters, probates, administration, and running a business and owning property, and creating a family trust that will protect you and your family across borders and down generations. Thanks for listening, and join us next time. In January, the weekly Wednesday webinar is going to be covered looking at UK tax for expats, with the UN tax submission deadline coming up at the end of January. It's very topical. We're looking at the changes that have been introduced and are coming into force in 2022. So Happy New Year. I've started 2022 already. Hope it's going to be a good one for all of us. Contact us and discuss how you can protect your family, business and overseas property from inheritance tax at probatepartnership.com. And we'll see you again for the next Wednesday webinar. Thank you.